Okay, welcome everybody. This is Elliot Katz here for the Rich Options Jerk. Uh, Unfortunately, the market gave up at the end of the day. And this is what I've been concerned about. Uh, I do apologize for not producing the newsletter last week. My son was in from California and things I don't see him very often. Things got a little out of hand. Uh, but if you've been listening to the webinars, you know that I've been watching a lot of charts here, and things are at best difficult. Seasonally, obviously, this is a weak time for the market, but there are some things going on here, as you saw today, where the market can't hold on to a rally. That's getting me a little concerned here now because of what we do here at the Rich Options Jerk with options. That's why options is in the name. We can turn around and we can go in whatever direction we feel is going to present the best opportunity for us. Now, sometimes in this transition phase, shifting from a long focus, a long bias, if you will, to a short bias, we may have a few trades that are a couple of duds here and there, but so far, and I'm going to be working with Jeremy on this because I would like to actually give everybody the history of the trades that we've been talking about here in the what we call the educational portfolio. Basically, we've had some very, very impressive results so far with our trades. Uh, we do have a couple that are on the cusp here of being our first couple of losers, but since we started this thing back at the beginning of July, we've actually had a very, very good run. And one of the reasons that we've had a good run is because of utilizing the principles that we teach in the course, namely a focus and a recognition, if you will, that stocks move through time. And because option prices are dependent upon the price of the underlying, its volatility, as well as the time that remains in the life of the option, by using different time frames in our option trades, we give ourselves maximum opportunities to create profits. Now, we know that because we're using spread trades, that our profits are not going to be unlimited, as they say, the big pops, but they should be a lot more consistent. And we're going to be hopefully producing that for everybody very, very soon. Uh, so I'm going to actually show you today uh, why this is how you actually use these concepts. We had a trade in Ambarella AMBA, which I actually took off today. I not only took it off in the educational account, I took it off in the real account as well. But before I took the trade off today, earlier today, I made a little movie uh, to show you folks how to assess market conditions and actually position yourself potentially in a much more favorable space. Uh, okay, but before I do that, I actually want to go through a couple of these charts with you so you can get a sense of what could be going on here. Oh, by the way, I I tend to do this every once in a while, sometimes stream of conscience. Uh, Netflix looks particularly vulnerable here, so don't be surprised if you see something going up in the educational portfolio. Uh, it's right on support here. It's filled the gap after the earnings, but we're starting to see the stock really have trouble getting going. And And we see that happening in a lot of stocks. I mean, it doesn't take a rocket scientist, to look at things like Amazon. We'll just wait for that to come up. We do have a little bit of a, stay with me here. Here it is again on the weekly and the daily chart. You could see that we got a sell signal here. And we did try to do a couple of out of the money call credit spreads, but we just didn't get our price. And we kind of missed this. So we're going to try not to miss any other opportunities if they present themselves again, especially things in the FANG universe, which is more than just Facebook, Apple, Amazon, if you do the AA FANG, Netflix, and Alphabet. But what I was doing today, I was actually going through the charts of the different sectors. Now, you may not be aware that there are not only indexes, there are not only ETFs, excuse me, for what we consider the major sectors in the marketplace, and you're probably familiar with those. That is this list right here. Hopefully you could see it on my screen here. It's this list right here. These are the ones that everybody's used to, the XLI, which is the industrials, the XLY, which is the consumer discretionary. Then we get XLF, which is the financials. Okay, so most people are aware of those. Some of you are not aware of the fact that a very valuable group of ETFs are actually a group of ETFs, and I think they're run by Guggenheim. All these with the R's, the Guggenheim, these are all equal weight ETFs. And the good thing about following equal weight ETFs as well as the cap weighted ETFs is that you can get a sense of what's driving the return in these ETFs. Okay, so think about it. If I have an ETF, let's say like this one, maybe you're familiar with the RSP, which is the equal weighted S&P. So if I'm looking at the XLI, which by the way is not looking that great right now, you can see it's really top. It has almost like a head and shoulders top here. Okay, but if I look at that industrials cap weighted and I look at the industrials equal weighted, you could see the equal weighted is doing worse than the cap weighted. Well, that's meaningful. That has meaning because if, some of you may actually have heard this around town, around the industry. People are talking about the fact that the market's getting more narrow. Well, this would be an example of how you could actually see that. You could see the market narrowing if the cap weighted ETF is outperforming its equal weighted cousin. Because since in the equal weighted ETF, every single stock gets the same vote, if the equal weight is doing worse than the cap weight, the equal weight eliminates the bias or the effect of the really, really big stocks. Every stock has the same vote. So when you're looking at these cap weighted versus the equal weighted ETFs, they can give you a lot of information about the breadth of the market. There are other ways, of course. You could follow the Russell 2000 versus the S&P 500, or in this case, here's a simple one, right? The Dow. The Dow's been doing much better than the S&P, right? You got the 30 stocks, you got industrial stocks, right? You got things in there that are not in the other indexes, right? I mean, if you look at the S&P, right, what's at the top, right? The FANG type stocks. What's in the NASDAQ 100, right? You don't see industrial stocks in the NASDAQ 100. So there's all these ways to look at things to get a sense of the depth and the breadth of what's going on. And unfortunately, we're seeing continued deterioration in that area. Now, because of what we do over here at the Rich Options Jerk, right, we're not really the kind of folks that are just going to go chasing after everything. Just because a car is coming down the street doesn't mean we're going to be a dog and just run after it. Okay, but if you make yourself a list of some of these individual industry ETFs, not the sector ETFs, the actual industry ETFs, and you can get this off of the ETF database. But there's a list. We have a list of 58 of these. And if you go through each one of them, what you're going to see is, except for the precious metals, which you might be familiar with, the GDX or the GDXJ, the utilities, and maybe a couple of the aerospace, the software ETFs seem to be hanging in there, and the consumer staples, which is another cause for concern, because when the staples are are leading the market, they're the most defensive stocks. So that's a cause for concern as well. Anyway, if you start just tooling through these, right, I'm not going to go through each name, but if you look over here on the left, you'll see there's the GDX, and you go to the next one, the GDXJ, the next one, okay, that's the brokers index. It's a financial index. It's the IAI. You go over here and you go, holy moly, what the heck is going on here? This is the broker dealer index. What the heck happened? What happened to Morgan Stanley? What happened to Goldman Sachs? What happened to all these things, right? That were leading the market. They were doing so well. Now all of a sudden things are getting a little more difficult. Is it just going to be a 10% correction or so? Who knows? Maybe it's over now. I don't know. But there's been enough of a what's the word? Compromise. These charts have been compromised enough that you got to be very, very careful around here. I mean, this one's actually just below its 50-day and pulled back to its 50-day. Okay, so from the point of view of being option traders and using the techniques and tools that we put in the Rich Options Jerk, we are not day traders. Okay, we're not weekly traders either. I'd say for the most part, our trades are going to go a couple, 3 weeks, mostly 3 to 4 weeks, perhaps longer, because we are using a time element. Obviously, if we're going to do a credit spread, that's going to be a shorter time frame because we want to get that theta decay. Okay, but my newsletter this weekend is going to be entitled Crunch Time, because I do believe that it is crunch time for the market. Again, from a trading standpoint, I can't look and say, oh, this is the start of a bear market, right? Anybody that thinks, they can predict that is, smoking something. But I think we will be able to tell as the evidence builds, that if the market keeps failing every time it rallies, that's a big difference, right? What happened to buy the dips, right? We could be going from a buy the dip area, from a buy the dip bias to a sell the rally bias. Okay, so be on the lookout for those changes and make sure that you pick up the newsletter this weekend. Okay, so what I want to show you today, and I'll definitely open it up for questions. This is unfortunately, this version of our Camtasia is one that I didn't put in the key for, the license key, because we're transferring it from another computer. So you're just going to have to deal with this little watermark here. But as they say in The Wizard of Oz, pay no attention to that man behind the curtain. So this down here, this was our position. I'll start the movie in a second. This was our initial position in Ambarella. Okay, you see, this was the position going into today. We're long the September 22nd 7:51 call right here, and we're short this Friday's 52 call. Now, if you look over here, you'll see that the price. Let me see if I can. That's a little too small. All right, I guess I can't make it's either full screen or not full screen. Okay, so wait, hang on one second. Let me try to see if I can make this a little bigger without filling up. There we go. Maybe that works. I think the other way we're losing some resolution. Okay, so we'll use this. Okay, so if you notice, you can see that the September 22nd 51 call is $3.10. That is the actual initial cost of that call when we put on the trade on August 7th, when the stock was $51.22. Okay. If you've been following along with us, we have over the last 3 weeks we were able to get the cost of that trade down from 260 down to $1.70 by first selling the August 11:52 call for 50 cents, then rolling that to last week's 52 call for another 45 cents, and then rolling that again to this week's 52 call for another 45 cents. So it's between the day that we put the trade on and August 18th, which was last Friday, we actually lowered the cost from 260 to $1.70. Now, with that in place, I'm going to start the movie so that you can see how to use one of the principles that we were talking about in the Rich Options Jerk course to create potentially a very favorable position. Now, earnings are going to be coming out next week. So what you're going to see here is an adjustment to the trade that takes advantage of that increased level of premium for earnings week. For those of you who are not aware, who may be just starting out with us, one of the things that we talk about is the fact that in earnings week, premium levels expand because of the increased level of uncertainty. So the implied volatility levels go up and the premium goes up. Okay, so what I'm going to narrate this movie as it goes by, and I'll stop it every time I want to make a point. Okay, but remember, this 260 is not really 260. This 260 is really $1.70. Okay, so as the movie goes by, I'll explain exactly what's going on here. Okay, all right. So there's the original trade. I mean, not the original trade. Those are the two current options that we have in the trade, right there. Let's see if I don't know how to speed this up. Let's see if I can speed it up. There you go. Playback speed. Ludicrous speed, right? Okay, good. So we're starting with a trade that's really $1.70. So when you look up here, right up here, this area right there is the stock being at 52 on the expiration day, which is this Friday. Okay. So what you have to do to understand where you're at in terms of a trade like this in this platform is you have to realize that that 260, which is over there, you have to add to that 260 the profit if the stock is 52 on Friday of about 45 bucks. Okay, because the system is telling you you're making 46 bucks off of $2.60 because it doesn't remember of all the other trades. So what I did here was I took the 260 cost that we have for on the board, and I added the 46 cents of profit that the model is telling me we would earn this Friday if the stock closed at 52. So that would make the position worth $3.06 on Friday. Again, the 260 that the system thinks we're long the trade at, plus the 46 profit. Now, moving ahead, what we notice, what you're gonna see is that since we're really long at $1.70 because we took in the premium, if we were to take that trade-off on Friday, if the stock were 52, that would actually turn out to be a $1.36 profit, right? It's the same 306. It's just that we have to measure it against the $1.70 cost that we have, not the 260 cost that the system thinks that we have. So if the stock's 52, we are going to have a profit of $1.36. Okay, now, one of the magical things about using trading platforms like this is that you can go to the platform and you can look at that $1.36. And now we can compare it to the adjustment. Okay, so let me stop it right here. Okay. The adjustment that we're going to make is we're going to roll our 52 call that's expiring this Friday and move it to next Friday's 52 call. Okay? Now, in order to accurately reflect the improvement in our $1.70 adjusted cost that this trade would make for us, we had to pretend that we were doing this roll for $2.30. Why? Because this is 260 and this credit of 230 gets us down to a 30-cent net cost, because it turned out that the roll from this week's to next week's 52 call was going to give us a credit of $1.40. And that $1.40 would have gotten our net cost of our trade now down from $1.70 all the way down to 30 cents. Okay, can you imagine that? We started the trade at the very beginning at 260. We got it down to $1.70 for this week. If we decide to roll out to next week's 52 because the earnings are coming next week, next Thursday after the close, if we went out to next week's 52 call, we would have brought in another $1.40 of premium, getting our cost down to 30 cents. So how do you reflect that in this platform? Unfortunately, as I said, because the system does not know that we've done other trades, it still thinks our cost is 260, but our cost is not 260. So we adjust the credit. We fool the system. We adjust the credit of the trade up to 230 so that the net cost of the adjusted trade is now only 30 cents. And once we do that, we get this brand new profit and loss diagram for next Friday. So let's start the movie again. And here's what I drew. So we're going to go to next Friday's expiration. Okay, remember this green thing over here is what our profit would have been at 52 if the stock were 52 this Friday. Okay, that's $1.36. Okay, so now we're going to look at next Friday. Okay, now it's earnings. This while I'm showing you, while I'm writing this down, it's showing you that I actually had to create the credit that would make the trade worth 30 cents. Okay, so as we go through the movie here, you could see that if the stock on next Friday was going to be 52, right there, there's 52. Right there, if you look on the bottom left, the profit is now $242. Okay? On September 1st, which is the day after earnings, okay? It's the day after earnings. That diagonal spread will now have a profit of $242. Just wait for it. It'll come up. For those of you who might be joining late, this is a movie I made this morning of an adjustment in this trade that I actually took off today to show you how you might be able to use the fact that earnings are coming to actually take in a lot of extra premium and put yourself in a situation that could be much more beneficial. So the $1.36 profit at 52 was Ambarella at 52 this Friday. This adjusted trade is a $242 profit if the stock is 52 on next Friday. But here's the kicker. The kicker here that you're going to see is that if you look at this line, which is next Friday, and you look up and down here at all the profit potential, you could see that there is a very, very wide range of profits. Here is the break even on the downside next Friday, which is 45. And you could see the break even. I don't even know where the break even is here. Actually, there is no break even here because it's a $1 spread that's only costing us 30 cents. So this actually, on the upside, no matter how high the stock goes after earnings, we would not earn less than 70 cents. So we have a break even down at 45, and we have a minimum profit of 70 cents if the stock takes off because of earnings. Okay, now remember, for those of you who joined late, the reason why the amount of premium we're getting is so high is because earnings are coming next Thursday. And the higher level of premium reflecting the uncertainty around earnings, and it happens with pretty much every stock, is allowing us to take in that additional credit. to lower our cost to 70 cents. I mean to 30 cents. Okay, so let's play this thing out. There's only a couple of minutes left. Okay, probably should speed this up a little bit more even, but just watch how this unfolds. There'll be a reason why I put that $1.36 up there this Friday at 52. What I like to do as a trader is I want to know, where will I make the same $1.36 next Friday if I decide to wait? Well, that line right there are the two delineate the two prices between which I will make at least $1.36. So this one over here, right there, that's somewhere around 49.28. Okay, so if I did this roll, I would make at least $1.32, $1.36 at 49.28. And on the upside, on the expiration day, hang on, let's see what's going on here. Let's just wait for this thing to play out. Let's wait for it to come back. Okay, so what I'm doing here is I'm showing you this orange line actually is August 31st, the day before earnings. Okay, the day of earnings. So you could see that there's a really nice profit there, even if we decide to take, if we had done the roll and decided to take the trade off on the day of earnings. The day are not the day after earnings, so the earnings are going to come out that afternoon. Okay, so this $1.30. Whoops, let me go back a little bit here. Let me go back. Let's go back over here. Let me go back over here. Let's go back over here. There you go. So this $1.36 profit, if we were going to do the roll, we would make at least $1.36 if the stock were somewhere between 49.90 and almost 56. Okay, almost 56. Okay, so what this is telling us is something really important. Okay, now turns out that I took the trade off today for $2.60 and I made 90 cents because I decided I didn't want to do this. But I made the movie this morning because I wanted to give you guys and ladies that are in the course some instruction so that you can do what I like to call think moves ahead. Part of being successful at this is to be able to think moves ahead. So what happened in this movie? Okay, what happened in this movie is I first showed you what the trade looked like this morning, just all by itself, just owning the 51 call for September 22nd and selling and being short the 52 call for this Friday. Okay, I showed you that the profit and loss that is actually being shown here is not correct because the system, unfortunately, you have to make these adjustments. The systems, the trading platform, this is Thinkorswim, does not remember all the trades that we've done. It only recognizes the current options that are in the trade. Okay, it's not keeping track. Okay, so this is showing us a cost of $2.60, but our real cost going into this morning was only $1.70. So what I showed you was that this profit at $52, if Ambarella were $52 this Friday, was a certain amount based on a $2.60 cost, not our $1.70 cost. So what I did next was I actually adjusted. So what I did next was I actually adjusted the final value at 52. I calculated the final value of the trade at 52 on Friday using the 260 cost that the system says we have, plus the 46 profit that is being modeled if the stock were 52 on Friday. And I came up with a $3.06 estimated value, simulated value. So that would have been a $1.36 profit if we didn't do anything. Okay, if we didn't do any rolls and the stock ended up at 52 exactly. Obviously, in a diagonal spread, which is a time spread, you're going to give up profits on the downside, right? Because on this side of the curve, on this side of the trade, the short is expiring worthless and the long is decreasing in value. On this side of the trade, the long is still going up, but so is the short, right? On Friday, the short option will have a delta of either 0, which is this part here, so it looks like the long call, or -1, because we're short. And it eats into that profit right there. See? Right there. Because the delta of our long call is not 1 yet, because there's still about a month to go. Okay? So that's what we would expect the trade to have looked like on Friday if we held on to Friday and the stock closed at 52. Then what I did was I went on to show you that if we decided instead, there we go, to take advantage of the extra premium that we're going to be paid for selling an option the week of earnings, there was enough premium in that roll, which was just a roll out in time. I didn't even have to lower the strike price. I just kept the strike price the same. And the cost of the trade went from $1.70 down to 30 cents. Okay. So now with the cost at 30 cents, next Friday, our profit loss now looks like this line right here. And you could see that the profit is enormous if the stock closes at 52, right? Why? Number one, at 52, the option we sold, that September 1st 52 call, is going to be worthless. And all that extra premium that we took in is going to go to 0. So whatever the residual value is of the 51 call for September 22nd, that's all ours. And since we're going to be measuring it against a net cost now of only 30 cents, the profit is going to be huge, right? It's going to be over 200, almost 230 or $240. I think it was $243. Now, what also works with this roll is that because the cost is that because the cost of the trade now is down to 30 cents, the earnings report could actually not be that great. And as long as the stock is at least 45 next Friday, we're actually going to make some money. Now, for me, a bird in the hand is worth 2 in the bush, so I took the trade off today. Yeah, that's what I decided to do at the end of the day today. Even though the stock ended up rallying into the close, the value of the spread actually was exactly the same as what I took it off at, and that's because of the gamma factor, which we're not going to talk about today. Okay, and if the stock were to really ratchet up because earnings were good, because we have a 30-cent cost and a $1 spread, there's no way we could make less than 70 cents if the earnings were really, really good. Okay, so this moved me, and I'm going to see if there's a way I can. This actually is recorded. So for those of you that want to pick up the archived version of this, uh, there it will be this movie with me talking just the way I've been talking now. Okay, so this is the first time that we've actually done something like this at the Rich Options Jerk. We've been doing this for the better part of a couple of months now. So really appreciate the folks that have decided to join us with the course. Remember, you can reach me, I believe, at Elliot at investingshortcuts.com, and I'll be more than happy to answer any questions you have. We've got a few minutes left here, so if anybody wants to type in a question, I think I should be able to see it over here. So if anybody's got a question, you can type it in, and I should be able to see it. All right, not getting any questions today. Okay, well, you can pick this up in the archives, which should be ready sometime later this evening or early tomorrow. And please make sure that you pick up the newsletter this weekend. It's going to be entitled Crunch Time. Okay, so everybody have a great rest of the week. Good luck trading. We are here to help you on every step of the way. Be well.